All right, so principal at scale. Right?
Absolutely,
but
yeah.
This isn't your first VC firm, right?
No. I've actually been a venture capitalist for basically a decade now. So I started at Montgomery & Company, an investment bank, and we tried to become a merchant bank. And so was doing some investing there in the mid-2000s, and then actually joined a firm called Crosslink Capital and went through a very traditional associate program there. Spent 3 years there, and then joined Scale just about 4.5 years ago.
Nice.
Yeah.
And so, you've been kind of helping out, doing a lot of things.
Yeah.
But, I want to talk to you not about the business of the VC stuff, but rather the personal aspect of it. I found this core answer you wrote a long time ago about, I guess I was framed as like what are the things that people don't know about what it's really like to be a VC, the downside, so to speak, of being a VC. And you gave a very thoughtful answer. And so one of the things you touched in there was this idea of like, it's a pretty lonely job, right? Do you still like stand by that statement?
Oh, absolutely. I mean, I think I popped on that Quora answer, and it just kind of hit me in one of those moments where, I was reflecting on this business, and it's a great job. I mean, I really, really enjoy this job. Like I said, I've been doing it for a decade. I can't imagine myself doing anything else. But one of the things that people don't talk about is what the job is actually really like. And I think compared to what I hear from my peers' jobs, or even what I experienced in my early career as investment banking, or I was a college athlete, was it's much less team-oriented than a lot of other things. It can be quite lonely, and specifically if you think about, the job as an hourglass. It's really lonely in the front end, and it's really lonely in the back end, and there's this piece in the middle where you collaborate. And so on the front end, I'm in my office, and I really have to ideate with areas that I want to invest in, themes, markets that I'm compelled about, and that'll induce me to go research, read some white papers online, maybe attend a conference. I probably attend that conference by myself, and lots of entrepreneurs are there. They're often with their companies because they're presenting in booths, their sales teams, and I'm there by myself, right? And then I go back, and maybe I decide to meet with 5 companies in a specific market or around a certain theme. And I do most of those meetings by myself. If there's one that's really interesting or starting to percolate to the top, I'll start grabbing my colleagues and I'll start bouncing those ideas off of them. And I start entering that middle of the process. And ultimately it gets to a point where, yes, as a group, we really intensely collaborate and work with one another. And here at Scale, I'm really fortunate to have great teammates that I can rely on and that will step in for getting an idea through the final point and through to the investment point. And at that point in time, our whole partnership actually works together. But in that span, it can take, on the shortest end, weeks, sometimes months, and in certain cases, years to get to a point where you get to that investment point. Then you make the investment, and you're on the board of directors. And once again, you're kind of by yourself, right? You have the other directors, but those aren't your colleagues. Mm-hmm. And you have the management team, but they're also not your colleagues. And yes, you all work together, but you're kind of in it by yourself to a certain degree. And then you come back and you report to your partnership, and maybe I have a very specific problem where one of my other partners has a strong suit, and so he'll come to the next board meeting with me, or he'll jump on a call, or she may know somebody that she can introduce me to. But there's a lot of one-on-one time. And so when people come to me and they say, hey, I would like to be a venture capitalist, I always like to highlight this point. Hey, this may or may not be for you, but it's something worth considering.
No, absolutely. And even the time where you're meeting people, you're grabbing coffee or all of that, it's not the kind of social interaction maybe you find in other jobs, right? It's much more superficial, maybe for lack of a better word.
I can sometimes go through a day or two where I'll trade emails with colleagues, but I actually don't talk to another member at Scale for a whole day or two, which I get really excited to go in the office and grab lunch with people. I'm like, yes, people who see me every day or know me every day. Whereas when you're meeting with entrepreneurs, often those are first-time relationships, right? You're going on, 5 dates in a period of 2, like 5 first dates in a period of 2 days, and you're finding points to connect with those people, and it's kind of lonesome.
Right, and so part of maybe what makes it lonely, it seems from the outside, is that competitiveness that there is between partners sometimes within a firm, but also between firms, obviously, right? The valley is, there's a lot of companies to fund, but there's not that many really great companies. People want to invest in the same. And I find that there's, from the outside, it seems like there's a lot of competition, but there's also a lot of cooperation sometimes. And I was wondering if maybe you could kind of explain a little bit more about that, like how that kind of shapes your daily life working as a VC?
I mean, I think one of the fascinating things about the venture industry is people who are your competitors one day are your partners the next day. And so my peers at other venture firms, we collaborate all the time because I'm interested in the companies that are in their portfolio and vice versa. But then the next week, we're both looking at a deal that both of us discovered, and we're going to be competing because we want to invest in that. And so it creates these fascinating dynamics where we're all playing this very subtle poker with each other. And I think turning the tune back to where I started my career, my investment banking class had 12 people in it. 2 of us are now on the buy side, and a number of other people had aspired to do that. There was probably, if you include my year, the year above me, year below me, across the industry in San Francisco, probably 50 people that were venture associates. I think maybe 5 of us are still in venture. And so it's this funnel that keeps getting narrowed of the people that actually continue in the industry and scale in the industry. And I think a lot of the people that remain are people that by nature are very driven and very, very competitive. And so, I think on the one hand, we all want to win, and rarely are companies backed by only one VC. But like you said, there's only so many great deals, and the people that enter this industry are all very competitive. And you look at your peer who's at another venture fund, and he just did a really good deal, and you're like, shoot, now it's my turn. I need to go find a really good deal. And so it really drives you to work a ton, and that once again kind of starts that loneliness cycle a little bit.
Yeah, and it seems it also drives kind of urgency, almost maybe in that hourglass shape of things take a long, long time, maybe up to years sometimes to get to investment. But then when that deal materializes, you really don't want to miss out on it. You don't want anybody else to swoop in and grab it. And so it seems like there's an intense rush of energy I've seen in terms of how that happens.
Yeah.
So the last thing I wanted to talk about on camera, because we had this conversation once in the kitchen. I didn't know this about the VC life at all, but when VCs put money into a company, there's a personal implication of that as well, right?
Yeah.
So could you maybe explain that story a little bit in terms of when investment decisions are made, when a person representing a VC fund puts money into a company, what does that mean for you personally?
Yeah, no, I think the economics of the venture industry are not that well understood, but traditionally the way that venture funds make money is the 2 and 20 model. And specifically what I mean when I say 2 and 20 is we get 2% per year of our fund size to manage that fund. And then once that fund gets returned, we get 20% of the upside. So if you imagine, for simple math, a $100 million fund, we get paid $2 million per year to manage that fund. And once we've returned, we invest $100 million. And then once we've returned that $100 million, each incremental dollar that we return, we get 20 cents off of that. So if we return $200 million on a $100 million fund, the partners would get $20 million. Now that all sounds really exciting. $2 million, $20 million, you're like, oh my gosh, all venture capitalists are really rich. And I think people read this and they're like, yeah, these guys are all driving Teslas and they all have homes in Sun Valley and life is good. Meanwhile, I live in a 900 square foot apartment in San Francisco and I don't own property. So something isn't adding up. And what that really comes down to, and I think for mid-level professionals in the venture industry like myself, VPs, principals, young partners, is that our limited partners very frequently want us to make a commitment too. And once again, this number is actually 2%, coincidence versus the other 2%. But if we have a $100 million fund, our limited partners, that's our investors, will say, we want you to commit out of that $100 million, $2 million. We want you to have skin in the game. And so we'll raise $98 million from other investors, and we ourselves will invest the additional $2 million. And for somebody, I'm in my mid-30s, now I don't have to commit $2 million myself. My partners, all of us would have to, if we had a $100 million fund, would have to commit our portion of that. But you can very quickly realize in a partnership of 3, 5, 7, 10 people, how these numbers can become quite significant. And so when we make an investment decision, we have to write our portion of that investment into the deal, and that can pile up. And so as you raise multiple funds, because it's very common for venture funds to raise a fund every 3 or 5 years, you start having multiple funds that all have these commitments. And so you're investing all of this money into companies that you really believe in via your funds, and you're really fired up about that, because in the back of your mind, you're like, I am going to own the Tesla, I am going to have that house in Sun Valley. But meanwhile, you're looking at your savings account, and it's just going down and down and down, because the truth of the matter is, in the venture business, the payback cycles can be very long. And so it's not uncommon for a venture fund 5 years in to not have returned all the invested capital yet. Very frequently, that can take 7, 8 years in less successful funds, sometimes as long as 10 or 12 years, or or in really difficult situations, it never happens, right? Now that's a scenario that you never hope for, but you can imagine, gee, if these cycles are 5, 7, 8 years across a couple funds, you can start being in a position to be an investor in these funds in your late 20s, and you won't see a single check back until you're mid-late, potentially early, mid-late 30s, early 40s. There's a 10-year gap there before you start seeing any sort of success. And so, to put it in company terms, there's a lot of money going out, and not very much money coming back in.
Yeah, but again, it's not that perception maybe people have schematically of like VCs playing with other people's money, right? I mean, your own net worth is really tied into a lot of these deals.
Oh gosh, I mean, look, personal finances are always a sensitive matter, but I'm very committed to scale, and I'm very committed to venture capital.
Right, that makes sense. That makes a lot of sense. Thank you so much, Alex.
Absolutely.